Hi, I'm Rachel Zargami. I'm based in the Stamford office of Cummings & Lockwood. Good morning. It's great to see you all in person. I am going to talk to you today about general tax law updates. The good news is there isn't much update. Everything that we were so worried about last year, and we would have had a full panic presentation here that would have left you all very harried, did not come to pass. Everything was struck from that proposal. But I'm going to talk a little bit about it because it generated some excitement within the Democratic ranks, and it's starting to be a little bit better understood. So we are a little bit fearful that some of these things could pass in a compromise, even though we have a divided blue executive branch and some shade of purple legislative branch. We don't know what will come back, but we do know what generated kind of the most fanfare. These are the things that people routinely point out are the big loopholes, the way that the wealthy supercharge their dynastical wealth and the things that people declare unfair. So I just want you to understand them, so if anything comes to pass, you understand what the implications are for your clients. This is the slide Meg just showed you. This is really the biggest and most impressive thing that you can know about for your clients and the things that they may come back to you and say, why didn't you tell me? My neighbor took advantage of this and I never knew. It is scheduled to sunset, and these are the highest exemptions ever. So if you have clients able to make a $24, $26 million gift, they should. We know that there will be no clawback. We know that even if the exemption drops to $1 million at some point in the future, your clients who made a $26 million gift next year are going to be okay. These are the types of things that clients get really mad about. But the clients who can make those kinds of gifts usually have in excess of $60 million, so not the average client, but those who can probably should. There is no rush, just to be clear, to make a $1 million gift or anything like that, because we know that the exemption will be something around 3.5 minimum, most likely 5, maybe even $10 million. So unless you're gonna really maximize the difference between the $5 million exemption level and the 13, there's no real rush. We have heard little whispers that things may happen before 2026. So it is a bad strategy to tell your clients, let's just wait till December 2025. We've seen in Biden's Green Book proposal for next year that he'd like to reduce the estate tax exemption sooner than it's scheduled to be sunsetting. So we don't know. Bernie Sanders proposed a $3.5 million exemption. It's probably unpopular, but you just don't know. The clawback rules, they are final, that if you make the big gift now, they will not be clawed back into your estate. You won't be punished later. There are some loopholes about retained interest. 2036 gifts may be clawed back, but a straight up traditional gift, you'll be safe. So let's talk about the biggest highlights that we would have, again, probably done some scary presentation about over the past couple of years. In the Build Back Better Act, these are the highlight provisions of how things could drastically change in the estate tax field. Right now, when you die, you get a step up in tax basis on all of your assets. An estate tax at a 40% rate is levied on every asset in excess of the exemption. So the regular American is exempt from estate tax, and they get a full step up on unrealized gains on property that they own at death. The carryover basis regime is familiar to us, and you might recall in 2010 we had that. There was no step up in assets at death. So if there is no step up, you have to go through your client's assets and look at their closing statement from 1972 in Nantucket to figure out what their tax basis is. It's acquisition value plus improvements. So the cost of the furnace, try to find the receipt. Step up in tax basis is great for record keeping because we don't have to do that. We just declare what the value is on the tax return, and that is the new income tax basis. So step up is a little bit of a nightmare in that way. But if the descendants plan to keep the property and not sell it, it may not have a terrible negative implication for them now. Let's talk about an iconic house, because this is kind of a typical situation for clients that own a house and they purchased it a long time ago. You may know that house as the Brady Bunch house. It was actually acquired in 1973 for $61,000, and it was actually sold for $3.5 million in 2018. Let's pretend that those 6 Brady children are theirs, and that both Violet and George died in 2018. And we'll talk about the implications. If there is a step up in tax basis, each of the 6 kids, Marcia, Jan, Brady, Greg, will receive $583,000. Okay, so they split the proceeds. They each have a 1/6 interest in the house. If there's carryover basis, they still each receive an interest worth $583,000. But if they turn around and sell the home, each one will only net $370,000. Okay, so that's a big difference, step up versus no step up, if you have carryover basis. However, there may be a more punitive form of this, and this is what really scared people. If they treat death as a realization event, even if those 6 kids want to keep the Brady family home in use, they have to come up with a $1.2 million tax bill within 9 months of death. So each of those 6 kids has to write a check in for $212,000. They'd still receive something worth $583, but they have to pay a tax. So what that's going to do is force the sale of property right after mom and dad die for most people who aren't able to write big checks. So we hope that death isn't treated as a realization event, but that's why it's a big deal. And as you guys know from managing a lot of portfolios with low basis stock, imagine having to dump huge positions and raise cash to pay a tax that you didn't necessarily want to sell at that time. It gets a little bit complicated. So keep your eye out for any changes there. Meg talked a little bit about GRATs, and GRATs are great. GRATs came about in a code provision from 1980, so very, very young. I'm just kidding, because that's my year of birth. So they've been around, and they are right out of the code. They are really simple. Here's the math of a GRAT-funded and a zeroed-out GRAT that the Walton family made famous. The IRS challenged them. The tax court disagreed with the IRS, and the family won. So this is a Walton GRAT. It's zeroed out. Family puts $1 million in, grantor gets $1 million and change back. The value of this gift, you report it on a gift tax return, it's 2 cents. You're not really risking anything. You're not really giving anything away, but there's a huge potential to give lots of property totally tax neutral, gift tax free to the next generation. They call this a loophole. They say that we are taking advantage of the system by using GRATs, and they would like to get rid of them as a legislative action. And so what they will do to make them less fun is create a minimum term. So now you have more mortality risk. 2 years is a very limited period of mortality risk. 10 gets a little bit more dangerous because it does fail if the grantor dies during the term. Essentially, it fails. They want to create a bigger remainder interest, so you actually are giving something more than just 2 cents away. You're using more of your estate tax exemption if you have to give away 25% or a $500,000 interest. Instead of giving away nothing, you're giving away something, which is harder for people. And they hate grantor doing tax-free swaps. So I'll talk about that in a second, but you can, right now, a grantor and a grantor trust can swap property, and there's no recognition event for income tax purposes. So they would want to prohibit swapping of property from GRATs. The grantor trust rules, it's very confusing because defective grantor trust, it's actually kind of an effective grantor trust. But back in the day, grantors were trying to spread out tax burden by putting in property and making separate taxpayers out of trusts. The IRS said, nope, we're going to basically tax all those trusts on the grantor's return. You can't sneak away and bury different incomes using different trust vehicles. So the grantor was stuck with the tax burden. From our standpoint, that's great. Give away money into a trust that's going to be exempt from estate tax and let the grantor use his estate taxable dollars to pay the tax year after year and allow that estate tax vehicle to grow totally income tax free like an IRA without any tax ever due. They don't like it. They call it a loophole. And they don't like the fact that you can, as a grantor, gift property with a low basis and some point later swap high basis property to the trust. So there's not much income tax liability within that trust and that's tax neutral. So what they'd like to do is make that transactions between grantor and grantor trusts recognition events and treat the payment of tax as an additional gift. This will happen after the effective date of the legislation. So anything you do now all these loopholes that you may be taking advantage of for your clients that are currently sanctioned, you can take advantage of them now. This may come to pass later. We'll see. The legislation was very sloppy, and I don't think they understood what the implications would be, so we'll see what comes from this. Discounts, these are routinely disliked. I have an example embedded in this slide just to explain what discounts are, but basically discounts allow for a 20 to 30% discount on assets if you use a wrapper, an FLP, Family Limited Partnership, or an LLC. How does it work? Well, the average person on the street doesn't want to be part of your family business, right? They'd rather just own the shares of Apple instead of working with your siblings on when to make distributions or not. So appraisers will assess discounts. So we'll see what happens with passive entities that aren't really a business, they're just investment pooled vehicles. They'd like to remove discount ability for passive entities. As for income tax updates, we have some state news. There's a Massachusetts millionaires tax for people earning more than $1 million, and that went to a popular vote just last month. And so now there's going to be an additional 4% income tax in Massachusetts, and that's very similar to what New Jersey implemented in 2020. So these mechanisms are becoming more popular with the people as like populist measures. So we'll see what happens. So far, we haven't seen much legislatively, but going out to a statewide vote and a referendum, these things are happening. So we'll see what happens with the income tax rates. And then Biden has proposed increasing the capital gains tax rate and qualified dividend rate by almost double, and carried interests, which are now treated as capital gains. They'd like to treat that as ordinary income for certain taxpayers. So we'll see. I don't know what will happen. A lot of this was not artfully drafted, but we do know what's kind of popular, and we just want you to be prepared. So so that there isn't wide panic if one of these things slips through. Thanks so much.